Are you considering dividend investing? Before you make up your mind, do yourself a favor and watch this video. See, investors are drawn to the siren call of yield. A distribution makes them feel good, and maybe it's not totally irrational to feel that way. But is it irrational to form portfolios to chase this feeling? Before talking about why actually avoiding dividends, in my opinion, may be a superior strategy, and no, I'm not just talking here about potential tax implications. Obviously, I want to dig deeper than that. Let's just talk about the Dividend Irrelevance Theory by Modigliani and Miller. What they made so obvious, or at least in retrospective seems pretty obvious, is what a firm decides to do with its earnings is more important than how they decide to do it. Is this company going to reinvest its earnings into the business, or is the better decision to redistribute the earnings back to shareholders? Of course, what we see in practice today is not necessarily what theory dictates. Investors absolutely love their yield. John D. Rockefeller is famous for once saying, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." Man, is it hard to get people to stop chasing yield. And the question is why? Why do people prefer income to capital gains? No doubt there's probably some human biases at work, and investors may actually be deceiving themselves and treating returns differently depending on the source of that return. This is what is known as mental accounting. And as evidence of this, let's re-examine what occurs when a dividend is distributed. Let's say, for example, that you have the same stock worth $10, but in one scenario, the stock pays a $1 dividend, and in the other scenario, it doesn't pay any dividends. Now, when the distribution occurs, the dividend paying version of the stock is going to drop to $9. Now, remember, if the stock has $1 in its balance sheet, when it's distributed back to shareholders, it no longer has that dollar. Therefore, it must be worth $1 less. This is just pure logic. Of course, the non-paying version of the stock hasn't moved and it's still worth $10 because it didn't pay any dividends. Now, in both cases, the investor still has $10. In the non-paying version, the investor has a $10 stock. And in the paying version, the investor has a $9 stock and $1 in cash. And let's say that the dividend paying investor, let's say the dividend investor wants to reinvest that $1 back into the stock. Guess what? He has $10 in that stock now, the same as the non-paying version of the stock. Now, this just goes to show you that the sources of return do not matter. Only the total return realized by the investor is what matters. So here's the main problem. I just show you the math and how it works, but people still perceive dividends as free money, even though it is most definitely not. There's this paper by Sam Hartzmark, whose work I'm also going to mention later in this video, where he hypothesizes that the price drop after dividends is just not as obvious, mostly because they tend to be relatively smaller drops, usually at market open where information also gets super muddled, and because prices also continue reacting to whatever else is happening that day. Investors then perceive this dividend as just an extra bump. Secondly, people might prefer dividends because they deem them as safer than price returns. Now, of course, with price returns, you're seeing them move up and down day in and day out, and therefore people kind of perceive them as riskier. So even if prices drop, investors still feel like they're getting some sort of return via the dividend, and they don't have to sell their shares to fund expenses. Yet another behavioral bias on display here, namely the disposition effect. So this actually leads investors to feel that during a bear market, they're not realizing any losses if they've received a dividend. It's just a different income stream. Again, these are all mental gymnastics investors play in order to feel that they're safe, even though the same economy that brings your stock price down could also take your dividend away. But I'm not here to argue that dividend distributions don't matter, even though that's all I've talked about in the video thus far. I'm actually going to tell you that dividend distributions do matter, just not in the way you expect. First off, of course, dividend distributions tend to get worse tax treatment than capital gains. So importantly, if you can avoid distributions, all else held equal, you should. But secondly, and this is actually kind of wild, in a frictionless world, selling before a distribution and buying after it may actually capture higher returns than reinvesting dividends. Now, of course, everything I told you at the beginning of the video runs counter to what I just said, but hear me out. In this channel, we talk about a lot of stock factors or anomalies that occur because humans misbehave. And this is actually another case of human misbehavior affecting prices. See, investors are so fascinated with yield that the chasing of yield is bloating prices that then deflate after distributions. I have to be honest, this is actually kind of perplexing, but I need you to hear me out. In the paper, The Dividend Month Premium, Sam Hartzmark argues that a portfolio that buys all stocks expected to issue a dividend this month earns abnormal returns of 41 basis points. And this is per month. In other words, buying a stock before an expected distribution earns abnormal returns because people just want their dividends. And what is really wild about this is that if this is true, there's a good likelihood that the demand for yield is so strong that the smart money is unable or unwilling to take the other side of that bet. In this chart, you can see how abnormal returns tend to cluster around the ex-dividend date, and then they plummet and actually experience negative returns after the ex-dividend date, meaning there are some pretty clear forces pushing prices up in demand for yield. And in a frictionless world, smart anti-dividend investors may take advantage by selling prior to distributions. Now, it's not just that, but higher yielding stocks actually have higher abnormal returns than lower yielding stocks. And get this abnormal return is also higher during high volatility episodes, meaning that yes, investors may actually think that dividends are safer and then they flock to them during stress markets. But how strong is this anomaly? Well, according to Hartzmark, the return of going long stocks during distribution months and then shorting during other months has had the same effect as the value factor, but with less volatility. Therefore, according to Hartzmark, it's not that dividends do not matter. They do. Targeting dividend-paying stocks and selling them before realizing the distribution may actually earn investors some premia. And this only makes sense as long as yield chasers are so large in number that they push prices up. Here at Alpha Architect, our goal is to empower investors through education. We're an asset management firm that focuses on delivering affordable alpha to our clients. If you want more educational content like this, head to alphaarchitect.com. I'll see you there.